Welcome back to College 101 again today. We're going to be talking about taxes. I know it's another financial topic. We still haven't gotten to the real meat of what you want to know about college, but I promise there's only going to be one more video after this. We'll be done with the financial stuff for a while. I do want to talk about this because kind of like loans and interest rates and all that, I feel like how taxes work or something that school doesn't really teach you all that often, and especially if you've been working just like a summer job or a part-time job in high school, you probably haven't really had to pay your taxes a whole lot. You may have filed them, but you get a decent sized return at the end of the year, and so you're not really used to how much tax you actually end up paying once you make a real salary that you're working full-time the whole year making a higher wage. As well, I want to go into how the more you make, the more taxes you'll pay and exactly how that works. And as always, I like to use some specific numerical examples, and so we'll go into that a little bit more with you. So I am going to focus on taxes here in the US, just in case there's anybody watching from somewhere else. This probably doesn't apply to you. The US has a progressive tax structure, and what that means is basically that the more you make, the more you get taxed. However, it's not that if you cross a line, your tax rate goes up for all your money. That wouldn't be fair. The way it works is there's these different brackets, so you think of it like buckets, and any money within that bracket or that range or that bucket gets taxed at a certain rate. Once you fill that bracket up, you go into the next one, and all the dollars in that next bracket get taxed at a higher rate, and then at a higher rate and a higher rate. So for this first example, we're going to use a salary of $50,000. For a lot of majors, a $50,000 salary out of college is pretty decent, pretty attainable, so I'm hoping that it will be a good example that will be really relatable to you guys. One other important thing to note is that tax brackets do change basically every single year, at least a little bit, and then oftentimes there are major tax system recalls. When we get a new president, they don't always get passed, of course, but basically the numbers I'm using today are a good illustration and they might not change too much, but also don't use these numbers if you're watching this video 1 year, 2 year, 5 years later or something like that. For the numbers for 2021, 2022, that first tax bracket is from $0 to $9,950. And that first tax bracket is taxed at 10%. So as long as you make more than $9,950, that first tax bracket is full and you're going to pay 10% on it, so you're going to pay $995 in taxes. The next bracket goes from $9,951 up to $40,525. This second bracket is taxed at 12%. So total, that bracket has $30,575 that will be taxed at 12% if you make more than the upper threshold. Because your $50,000 is more than the $45,250, you're going to be taxed at the full 12% for that whole range, and so that's going to be another $3,669 on top of the $995 you paid. So far your tax got up to be $4,664. But you still have money left over beyond that second tax bracket. So we're going to pop you into the third tax bracket, and this is a pretty significant jump. This tax bracket is from that $40,526 up to $86,375. This tax bracket is taxed at 22%. And if you want to think about the logic of it, some of the idea is that the first money you make is probably covering essentials, it's food, it's housing, it's living expenses, and the government will tax you some, but they don't want to take a ton of your money because you need it to live. Once you get past a certain amount, they start raising the tax bracket. So this next tax bracket is taxed at 22%, which is a pretty big jump from the 12%. However, you aren't having this bucket filled up. Your $50,000 is only a little over $9,000 over the limit, right? It was $45,250 to $50,000. You're looking at $94,750 that's going to be taxed at this rate. So you'll take the $94,750 left in that bracket, multiply it by the 20%, and pay an extra $2,084 for a grand total of $6,748 in taxes for a $50,000 earning. Because of the way this progressive tax structure works, every dollar after that, let's say you get a raise or you're working a second job or whatever it might be, then every dollar after that is taxed at 22% up to $86,000. And so every time you make a dollar, you're only going to see 78 cents of it. But wait, aren't taxes supposed to be complicated? I just explained it to you, and hopefully that made a little bit of sense. The numbers hopefully helped illustrate it. Well, there's a few more factors that come into play. The first thing to know is that the tax brackets are dependent on what they call your filing status. What that is you're basically declaring who you're supporting and what sort of family structure you're in at the time. So the most common filing statuses are single, married filing jointly, married filing separately, and head of household. So for certain people and certain reasons, you may, even if you're married, you may want to file your taxes separately, and that's why there's a different set of tax brackets for that. But what I'm going to use to illustrate the differences here are the single and the married brackets, because that's probably where most of you guys are at if you're in college or just freshly out of college. The reason for these brackets is that, especially if you're on a one-income household, even though you're married, the idea is that you're supporting more people, and so a greater percentage of your income is going towards living expenses, probably bigger rent or a house payment or things like that. And so they don't want to tax you as high on as much of your income if you're using that to support a family rather than more disposable income, we'll say. So for married people who are filing jointly, that first 10% tax bucket goes all the way up to $19,900, and the 12% tax bracket goes all the way up to $80,050. So for a one-income household, you save quite a bit of money because you don't have any money in that 22%, and you also have a lot more money that's in that 10% rather than the 12%. And if you think this seems unfair, the way to think about it that balances it out is if you are married and you're a two-income household, then because you have two incomes, the top end of your income or the second income, it's much more likely to be in that upper bracket, and it's mostly the same as if you were two single people working separate jobs and you had those lower tax brackets. So it all kind of comes out in the wash. All right, break time. Why do hunters have such low taxes? Because they have so many deductions. Because, you know, they go hunting and get rid of ducks. If you found this video helpful or really enjoyed the puns that I put my time and soul into, please like the video, subscribe to the channel. If you really just think that puns are the lowest form of comedy, then please subscribe to the channel, click the notification bell so that you can come and let me know on every single video. The next concept that makes taxes a little more complicated are deductions. What deductions do is they reduce what percentage of your income or how much of your income you have to actually pay taxes on. And there are lots of individual small tax deductions that you can get for various things. However, to make things simple, there's also something called the standard deduction. So the standard deduction is basically just a way to make things easier on you and easier on the IRS, so that if you don't want to go figure out all your individual deductions, charitable contributions and things, you can just take the standard deduction. And for most people, it's probably the better option anyways. So for a single person, the standard deduction is $12,000, and for married filing jointly, it's $24,000. What that means is that in our example where you had a $50,000 salary, you would reduce that by $12,000 when figuring out your federal income tax. So you'll only be taxed for $38,000. Now, why is that so important? In our example, that's really important because not only is that $12,000 you're not paying taxes on, but it also brings you out of that higher 22% tax bracket. Now with your taxable income at $38,000, you're not going to hit that limit. Therefore, even if you get a raise or you have a little side gig or whatever, that money is still going to be taxed at 12%. You're going to see a little bit more of it. And actually, I misspoke. That number is old. The standard deduction for 2021 is $12,550 for single people and $25,100 for people who are filing married jointly. Even with all that, it might not seem too complicated, right? And it might seem like taxes aren't too big of a factor in your salary. Well, there's still more. What we just talked about was the federal income tax. There are a couple other taxes I want to talk about that are really important. The first one that I want to talk about is FICA. FICA stands for Federal Insurance Contributions Act, and this covers Social Security and Medicare. It amounts to 7.65% of your salary. The full FICA tax is actually 15.3%, but if you're a full-time regular employee, not a contract employee, your employer pays half of that tax for you, so you only see 7.65% of it. Hypothetically, you get this money back when you're drawing Social Security and using Medicare once you're retired. So you can kind of think of it as like a forced savings program by the government. It still kind of hurts coming out of your paycheck when you say, well, I earned this much, and 7% or 7.5% is non-trivial to me. So looking at that $50,000 salary, FICA for that year would be $3,825. One of the other reasons why FICA can hurt so much coming out of your paycheck is it ignores deductions. And so you're being taxed 7.65% on the full $50,000, not just on the $38,000 taxable. The last tax I'm going to talk about is a state income tax. Now, every state does it differently, but to sort of generalize, most of them have a flat tax rate. Some of them might have a progressive tax structure, just like federal income tax, but most of them, I believe, have a more flat income tax rate to make things simpler. For example, where I live here in Utah, it's 5% of your income. Just like the federal income tax, it often does go after the deductions, and so that would be 5% of your salary after that standard deduction of the $12,550. So if you're on that $50,000 salary, that state income tax of 5% would come out to $1,872. That makes your total tax burden somewhere between $8,120 or $9,992, depending on where your state income tax might be, or if you don't have it at all. There are several states that don't have a state income tax, which is why some people really like to work there, live there, or retire there. Looking at that total tax burden somewhere between $8,000 and $10,000 out of 50 does mean that taxes are about 16 to 20% of your income. I will say I'm not an accountant or a CPA or a tax guru. I just use TurboTax, to be totally honest. And so there are certain tax deductions and tax credits that I do take advantage of through that system. And so that 16 to 20% is probably a high estimate. That 16 to 20% is only if you just look at your salary, take the standard deduction, and then pay your taxes that way. So to summarize, taxes are 7.65% on everything you earn, plus federal and state income tax on your taxable income, which is typically going to be your gross salary or your full salary minus the standard deduction. There are a few other things that we might talk about in future videos. For example, if you put money into a 401k retirement account through your employer, that money comes out pre-tax, so that reduces the amount of money you're paying taxes on. There's also things like HSAs you can put money into. If you pay insurance premiums out of your paycheck, those are also before taxes are paid. So again, it reduces your taxable income, takes that 16 to 20% down a little bit. So maybe that 15% number I used in the last video is a little more accurate. If you're really interested, I will get more into the weeds on that in some future video to talk about tax deductions and pre-tax deductions from your paychecks and things like that. But again, I really want to get back to college content for you guys. I just wanted to lay this foundation for you about how taxes work. So just like last time, when you're looking at how much you think you might make in a given career, you can know how much to reduce that by for taxes and savings, and what it might really cost to live and work in the US. Thanks for tuning into this episode of College 101 here on the College Guide. Please let me know if there's any questions you have or more topics you'd like to hear about, and I'll do my best.